Jerry Salah, who's Chief Strategist at Red Tower Asset Management, joins us on the phone line from London. Jerry, thanks very much for speaking with us. What is it that you're monitoring in terms of risk appetite in the region right now?
Yes, hi. I think basically we're all looking at the same thing, which is a little bit of reduction of risk appetite in the Eurozone, not just because of the disappointment in some of the quarterly earnings in the U.S. or maybe a few continued worries about Japan and China, but just because things that actually haven't been solved in Europe. I think we all expected Spain to have gone to ask for money by now. But we've been saying that chances are they're not going to because they're trying to basically play it both ways, get the benefit of having the threat of ECB intervention so that actually having to go through the austerity measures that the IMF or EU or ECB may impose. So we think that Spain is playing a very tricky game here, and you've seen the 10-year bond yield drop down to 5.3, 5.25, then come back up to 5.6 plus. We think it's going back to 6% and higher in the 10-year yield in Spain, which would put pressure on the euro and obviously cause more risk-off trading to continue. So we're looking at the euro dollar as a gauge for this, try to drop below 129 towards 128, maybe today or definitely early next week. And then we're looking for things like the Aussie dollar and the Kiwi and the Canadian dollar to come under pressure as well. And to leave gold prices to probably drift below $1,700 an ounce towards 1,660 and maybe down to 1,600 again and lower. Obviously, we are looking for U.S. Q3 GDP later on today as well to show that the U.S. growth is positive, but not really strong enough to be worrying for anybody.
How much is there a risk of the fiscal cliff at the end of the year that you're counting for right now?
In terms of risk in general or risk in the U.S. in particular?
Risk in general, because that event would have an impact on the U.S. economy and its markets, thereby have a dominant effect.
Yes, we're kind of looking at this from two sides of a coin. On one side, it's, obviously if the U.S. says we're not going to pay any bonds, then everything goes very, very badly for everybody. If the U.S. basically says we're going to put in automatic spending cuts and we're going to force people to make logical decisions, then that's probably a very good positive for U.S. bonds. The U.S. economy may suffer a little bit of some sort of uncertainty, delays spending, if uncertainty delays investment, if uncertainty delays any sort of positive things you'd expect in a normal economy. And that's probably another positive for U.S. bonds. And if the general risk appetite reduces around the world, then that's actually going to be a positive for the U.S. dollar, given what we've seen over the last 5 years in trading patterns. So it's going to be one of those funny situations where bad news from the U.S. would benefit U.S. bonds and U.S. dollar holdings, and that's about it, really.
All right, Jerry, we leave it at that. Thanks very much for joining us and giving us that perspective. We'll take a short break on that. When we come back, wrap up today's action.